So, when the Federal Reserve starts pulling the economic levers, is it a gentle nudge or a huge shove that sends everything flying? That's really the big question at the heart of a paper by Olivier Coibion called Are the Effects of Monetary Policy Shocks Big or Small? And today, we're going to break down his entire investigation. You hear this stuff on the news all the time, right? The Fed is raising rates to cool down inflation. But how much does that actually hurt the economy? I mean, does it just gently tap the brakes? Or does it slam on them, sending us skidding into a full-blown recession? It's a super fundamental question, and for a long time, economists had two completely different answers.
And to really get why this matters, let's jump in a time machine. This is unemployment in the US. Just look at that terrifying spike in the early 1980s. People call that the Volcker recession, named after the Fed chair Paul Volcker, who hiked interest rates through the roof to kill inflation. Now, the story we all tell is that his actions caused this massive wave of job losses. But did they? And if so, how big was the impact, really?
And this gets us right to the central mystery, because when economists tried to actually measure the impact of a Fed rate hike, they got two wildly different results. It was like having two witnesses to a crime, but their stories didn't match up at all. So let's meet our two witnesses. On one side, you have the standard economic models. These are often called VAR models. And they consistently said that a surprise 1% rate hike, well, it had a pretty small effect on the economy. But then, a really influential study came out in 2004 by two economists, Christina and David Romer. And their method found the exact opposite. That same 1% hike had a huge effect, a really big deal. So, who is right? And what's so cool here is that you can literally see the conflict with your own eyes. On the left, that's what the standard models say happens to industrial production after a rate hike. See that tiny shallow dip? It's a small effect. Now look at the right. That's the Romer and Romer result. Look at that massive, deep hole. That is a big effect. The difference is just wild. One is a gentle tap, the other is a knockout punch. This is where Olivier Coibion's research comes in. He basically decided to play detective and figure out why these two methods were telling such different stories. He started following the clues to get to the bottom of the whole mystery.
Okay, the first clue has to do with the shocks themselves. You know, in economics, a shock is just a surprise move by the Fed, a rate hike nobody saw coming. And Coibion realized that the two methods were actually identifying very different kinds of surprises.
This slide shows you exactly what I mean. Just focus on that bottom row of graphs. On the right, you've got the Romer and Romer shocks. After one of their surprises, you see interest rates jump up, and they stay high for a long time. Now compare that to the standard model on the left. The rate hike is smaller, and it disappears pretty quickly. So the Romer and Romer method wasn't just finding bigger effects. It was finding the effects of much bigger, more sustained actions. No wonder their results were bigger. And that first clue leads us straight to the second one. Coibion noticed that the biggest disagreements between the two models all seem to happen in one very, very strange period for the US economy, the late 70s and early 80s. So what was so weird about this time? Well, it was a brief experiment where the Fed basically decided to take its hands off the steering wheel. Instead of directly managing interest rates, they targeted something else entirely. The result was chaos. Interest rates went on this insane roller coaster, which makes it incredibly hard to tell what was a deliberate policy choice and what was just random market noise. And this graph, this is pretty much the smoking gun. That solid black line represents the Romer and Romer big effect. Now notice those huge downward spikes right around 1980. That's what happens when you remove just a few data points from this chaotic period. It shows that their entire big conclusion was basically being propped up by a handful of outliers from a time when the data was the least reliable. Yikes. Okay, the final clue is a little bit more technical, but stick with me, because it's like discovering the detective was using a faulty measuring stick the whole time. It has to do with how much historical data the Romer and Romer method chose to look at. This is where the detective finds that faulty measuring stick. In simple terms, the line along the bottom is how much history the model looks at to make its decision. Now, just follow the solid line. That's the Romer and Romer model. As it considers more and more past data, as the measuring stick gets longer, the effect it finds gets bigger and bigger. That's not how reality works. An effect shouldn't magically grow just because you look at more history. This was a major statistical red flag. So, let's put it all together. We have a faulty measuring stick, and we have a set of results being totally skewed by a few weird data points from a chaotic period. what happens if we correct for that? What if we just take that noisy 1979 to 1982 period out of the equation? And here it is, the aha moment. The solid lines show the original big Romer and Romer results. The dashed lines show what happens when you remove that noisy 1979-82 data. And look at that, the massive effects just shrink dramatically. The two conflicting stories suddenly snap together. The mystery is solved. After following all the clues, Coibion's investigation reached a clear, decisive conclusion, one that finally resolves this big debate. The effects of monetary policy shocks aren't big, and they aren't small. They're medium. But what does medium actually mean for the real world? Well, it means that a surprise 1% rate hike from the Fed causes industrial production to fall by about 2 to 3% and the unemployment rate to rise by about half of a percentage point. That's a significant real-world impact, but it's not the catastrophic blow that some had suggested. Now, you might be thinking, medium? That sounds kind of like a boring compromise. But it's actually the most important takeaway of all, because it reshapes how we understand our own economic history. As Coibion himself puts it, the evidence is clear. The answer isn't big or small. It's medium. And having this unified view gives policymakers and economists a much more reliable guide for the future. And this, right here, is why medium is so powerful. On this chart, that dotted line is what actually happened to the economy. The solid line is the part of that story driven only by these monetary policy shocks. Even with this corrected medium effect, you can see that policy shocks were a massive force shaping the recessions and booms of the 70s and 80s, including that big Volcker recession we started with. So what does this all boil down to? It means that decisions from the Fed aren't a gentle nudge or a nuclear bomb. They are a significant, powerful force. This medium view confirms that the Fed's actions were a primary driver of the volatile stop-go economy of the 70s and the deep recessions of the 80s. In short, this research gives us a much more accurate way to view our own economic history. And that leaves us with one final thought. We now have a much better map of cause and effect from the past. So the real question for us, right now, is what does this clearer history tell us about the risks and rewards of the monetary policy choices being made today?